All right, what's up, everyone? This is Brandon Rush. Thank you for joining us for another episode of The Agent Investor. The Agent Investor is a series committed to having conversations with real estate professionals in regards to multifamily, commercial, and other investment assets. Today, we have Gwyeth Smith, a good buddy of mine who I'm partners with, or not partners with, but members with in the mastermind is how I originally met Gwyeth. Gwyeth is a syndicator of many things, and I'll just let him jump in before I say too much. Gwyeth, thank you for joining us today.
Brandon, thank you, man. Appreciate you having me. Looking forward to it.
Yeah, no, absolutely. Gwyeth, tell us a little bit about yourself, your background, how you're involved in real estate.
Yeah, I got you. It's a little bit of a long, convoluted story, but I'll try to condense it as best as possible. I came from the world of economics and equities, so I was a stock trader for many years. Got into prosthetics, got into allied health, made a switch there, but always was somebody who was looking for multiple streams of income, looking for other kind of side gigs, always looking to have a backup plan to the backup plan to the backup plan. And ultimately decided to purchase some real estate, got some smaller multifamily, got a duplex and a fourplex in Pittsburgh. And from there, got into a 13 unit. I started getting involved with communities and masterminds and learned a little bit about syndications. Did a couple co-sponsorships with a group that I had met and become close with, primarily just raising equity. And at that time, I had met my partners and we had purchased a 42 unit building together in Southern Indiana. And we were just four guys kind of doing a deal together here and there. But it's kind of said as if we did that and things worked out well with us and we enjoyed working together, that we would try to take the next step together, which we did. And ultimately got involved in some deals where we brought in outside investors, then kind of went down that syndication path, did that 3 times. And that sort of brings us to where we are today with our company.
Yeah. And with you guys as a team, how many properties do you guys have, assets under management or doors per item, however you want to say?
From a doors is about 260-ish. That's probably spread across 7 or 8 properties. We recently closed one of our properties, which was 194 units. So that brought our count down a little bit. But yeah, that's where we are.
Okay. Yeah. Speaking of that project, how long did you have that project held for?
So that was one that we acquired back in 2020, and we closed May of this past year. It was just under a 2-year hold period.
Got it. So I'm going to flip-flop on questions. I'm going to come back to that property because it actually would be a good, quick project to talk about. But you kind of mentioned it, but talking about your path to syndication. Personally, obviously, you said you started investing, you bought a duplex, bought a couple of properties, and it kind of built from there. Well, how did you progress from small multi? Like, when was it the deciding point that you need to kind of leapfrog into bigger properties and team up, and like, how did it come about?
I think I had that mentality back then that I wanted to grow, and maybe I had the number of doors as something that was important to me. But in all honesty, what kind of got me there was finding the right people to work with, finding my partners who I work with now, and having that level of trust. I always joked, like I had that 13 unit at one point where it was just me, and every other property was with my partners. And I would tell them all the time, like, I'll give you guys ownership for free just to have somebody to commiserate with on the bad stuff and celebrate with on the good stuff. So for me, I really enjoy working with the right people.
Got it. Was your wife involved I'm assuming, on your 13 unit when you had it alone, kind of together?
Yeah, we started buying as us on that stuff. And then when I started growing and partnering up with some other people, she was less involved.
Got it. Okay, we're going to flip back to what we were talking about before. So the 194 unit, kind of give a quick, couple of minutes on how you founded acquisition, what was involved in disposition.
Yep. My lender at the time, he was my agency lender. He had introduced me to somebody that was in the same market that we were in, me and my team. And I mean, still remember it to this day. He had basically said something to the effect of like, so-and-so, it's like you would bring this to him and he would bring this to you. And he was just dead on. We started looking at stuff with them and kind of grew that relationship a little bit. He calls me coming home from work one day, and this is when I was still working as a prosthetist. And he's like, hey, man, I think I found something in Ohio. And he wasn't in Columbus at the time. And I'm thinking, maybe he's thinking Cleveland, Toledo, somewhere like this. I was like, I'll take a look. And when I got home, it was something in Columbus, and it was something that was pretty interesting, and the cost basis was attractive. They had a really strong construction arm to what they did in their company. We were more on the asset management side of it. So we kind of worked out a deal where we would acquire together. They would handle the construction because this was a heavy lift. We would handle the management. We were bringing our management team in, and basically structured a partnership between us on the GP side that way. And then we brought in our limited partners on that side of the deal.
Nice. How many limited partners did you have on that deal, roughly?
Limited partners, I want to say we were probably around 20 to 25.
Okay, got it, got it. Now I'm assuming there's a 506C.
That was a B. That was
B. Okay,
506B. Yeah.
got it. And quickly, I mean, the high level 506B versus 506C. What are the high level differences between the two? You would say.
High level is on the C, you can only attract accredited investors, so you have to meet that criteria. On the B, you can have both accredited and sophisticated, but you can't market to everybody. You need to have a pre-existing relationship with any investor that would come into that deal with you.
Got it, got it. And I was always curious, is the reason why the B is set up the way it is because obviously those people may not have the net worth. And advertising publicly, you could potentially attract investors who really have no business investing, and it could lead to a lot of turmoil and trouble. Is that one of the reasons why they don't allow?
I would say everybody maybe has different reasons for why they would go one way or the other, but I mean, for us, and I'm not sure if I'm answering the question as you asked it, we wanted to make sure that we could present it to friends and family who may not be qualified. There's also some other laws that you got to follow on the 506C side. You would have to have any accredited investor run through either an attorney or an accountant just to validate the accreditation. Whereas if you're on the 506B side, it's as easy as a kind of a checkbox on your offering memorandum or your subscription agreement to say that you're either sophisticated or you meet these criteria that would qualify you as accredited.
Got it. Understood. All right. No, cool, cool. All right, now perfect. Yeah, and that same project, in the middle of it, what was, a summary of the plan? How'd you guys?
Yep. So it was a project that had a lot of deferred maintenance. When we acquired it, it was probably around 70% occupied. And this is across two properties, the 194. It was a two-property portfolio. No real renovations, unit renovations done to that time. Dilapidated pool that was not in use. Landscaping was a mess. So our plan was to go in, address the exterior CapEx items. We ended up just ripping the pool out altogether and landscaping over it as opposed to repairing it. And then we went in and did the individual units. And I want to say, if memory serves, there were 194 units. I want to say we did about 120 of them in about the year and a half. Once we got under contract to sell, we had it worked out in a sales contract that we would continue to renovate just to protect us on the back end if sellers backed out or whatever it was, but we would charge those renovation costs to the buyer.
Got it. And how the heck do you renovate 120 units in a year and a half? Like a lot of moves or vacant? Well, you said a lot of it was vacant. You said 70%.
Yep. Yeah. There was a big vacancy in the beginning, and then, there was a lot of turnover once we took over.
Got it. And when you have those large vacancies, if assuming you can get the financing, is it better to do that and then basically move tenants between units to renovate their units?
I think in an ideal scenario, like that works. You can say like, oh, we'll renovate one unit and we'll give somebody the option to move to that unit and then go there. Our situation, we didn't have the best tenant base. In addition to the physical occupancy of say 70%, there was a lot of people living there who weren't paying. So we weren't really willing to kind of move them to a brand new unit.
Got it. Okay. So I created a whole nother layer of overhead to take care of. Okay. Yeah. Now, cool. So speaking in terms of roles and teams, because I know in a syndication, fundamentally there are 4 or 5 different roles within a team. It could be one person or it could be many people. What role or roles have you played in syndications, and which role do you like and which role do you dislike? Or you don't have to say it, but
yeah. I wear a lot of hats these days. So originally, kind of back then, I was more on the acquisition side of it. So I was the one deal hunting, structuring the deals, the finance background. I was the one underwriting the deals, kind of setting those budgets, those projections moving forward and tracking that stuff. Recently, I've gotten more and more involved in the operations side of it. We actually just brought management in-house on a couple properties that we have. So we're building out that property management arm of how we're envisioning this company being. And that's been taking a majority of my time these days. I feel like with where we are, both market cycle wise and in the economy, to say there's fewer and fewer deals, maybe that's true for some, not true for others, but we sort of slowed down on that front to focus a little bit more on the operations front and kind of taking this time to build this out so that we can become more efficient and more comfortable in our buying, just knowing that we have the operations sort of in place, intact, and we can kind of just make everything more efficient and work together more seamlessly.
Got it. Yeah, no, absolutely. And so you're bringing on a property manager. Is it just for efficiencies at this point because you have a certain amount of property in the area that they can take care of versus one property manager, savings and costs and things like that?
The first one that we brought in, it was really a little bit by necessity. The management company that we had wasn't performing how we wanted. So we kind of spread a wide net looking for what to do next. And in that wide net included interviewing people that we would bring in as a potential property manager. And as we went through that process, it seemed to make sense to give it a shot. And so we ultimately made that hire, and then we started building out what that property management company sort of looks like and feels like, trying to get all these policies, procedures kind of on paper. And that person that we hired, she came with a lot of experience. So she's been a big help in building that stuff out. So the second hire that we made in a 78 unit property, which is in another state, we were able to hire somebody who maybe had a little bit less experience, but that first individual we hired, she's kind of acting in that regional type role at this moment. Even though she's the on-site property manager, we kind of foresee some bigger things for her, and that's just going back to how we're trying to build it.
Got it. Good. Let me see. So one thing I've known you for is underwriting, just because we've done multiple underwriting calls and I've seen your built spreadsheet, let's call it that. When it comes to underwriting large multifamily, talk about some of the important aspects that either most people miss or they really need to consider when investing in larger multifamily, that maybe from your opinion.
I think a very common thing that we see week in, week out is people are looking at deals and they don't really take the tax reassessment into consideration, and what that could look like in a worst case scenario. A lot of people out there and a lot of buyers out there, they're doing their best to address that tax liability, whether that be by entity sale or some other strategy, which is great. I mean, you can underwrite to that to a certain extent. It's going to bring a little bit of risk, obviously, but understanding that every market is different, every county is different with how they reassess taxes, when they reassess taxes, all that stuff, and just knowing what to expect. Because if you look at some of these broker OMs and you see $100,000 tax bill, you carry that forward, and then you realize that when you get hit up for 280 and your tax bill just tripled, you're wondering, where's cash flow going? It's pretty obvious.
Oof. All right, so you got taxes. Anything else that you see that people often miss or overlook or don't really pay attention to?
Other thing I might kind of comment on is I always try to have the underwriting be a continuation of the existing T12. I look at it on a monthly basis. So if I'm looking at a T12 and I'm looking at my underwriting, month 13 is our takeover month. So if you see collections at, call it $100,000 from their month 12, and then your underwriting starts at $120,000, what are you doing so differently that you're collecting 20% more rent than the last guy? So just making sure that you're taking that into consideration. I know a lot of times people look at things on an annual basis, and like that year one is pretty different than previous year or existing year. So just kind of trending to where your pro forma is as accurately as you can, but also just knowing that you may have some dips. Like it's not going to be a straight line path to your pro forma.
Got it. And question, with that said, so is your underwriting usually pretty conservative, when you first take on a property, just because there may be a lot of unknowns that weren't disclosed when purchasing?
I try to be, and you have almost different underwritings, right? You have like your underwriting for yourself, which should be the most conservative, telling you if you're getting into a deal. Your underwriting for your lender might be a little bit more aggressive because you want to optimize the loan you're going to get, or at least have the ability to. You'd rather tell them, I'd like to take less proceeds, than for them to look at your underwriting and say like, hey, you're not going to qualify for XYZ. In terms of accuracy versus conservativeness, it's a fine line that you have to balance. I mean, if you're going to be too conservative, you're not going to be very competitive in terms of landing a deal. But at the same time, if you're not conservative enough and things come up, you're going to find yourself in a sticky situation.
Absolutely. Okay, that makes a ton of sense. Let me see what else we got here. So kind of taking a step back from larger syndicators who may be syndicating hundreds of units, but stepping back to individuals just looking to break it, like example like me, I own a few small multifamily and I understand the value of a team, kind of no idea of my role. And now I'm thinking of maybe I should syndicate a deal in the near future. Someone in my position or someone who's getting into their first syndication, they maybe want to take on a smaller building that's either of a smaller size, say 20 units, or a smaller, maybe a couple of $1 million, maybe $1 or $2 million. What are your recommendations for someone who's just starting out?
I mean, again, I feel like everybody's different. So I think my path maybe isn't the same as yours, but I think maybe kind of similar from what I'm hearing. I didn't have that confidence to jump into a 100, 200, whatever it is, unit
Mm.
property. In the beginning, I needed to prove concept on something smaller. I know there's a lot of people out there saying this all starts up here and it's like
Yeah.
limiting beliefs and this, that, and the other. To a certain extent, I get it, but also to a certain extent, if things go sideways on a 20 unit, it's probably not going to be as debilitating as if things go sideways on a 200 unit, right? For both reputation, what it could do to you financially, et cetera, et cetera, et cetera. So I'm a fan of starting kind of in a comfort area of where somebody may be. But again, everybody's different.
Got it. No, absolutely. And I didn't give you this question already before or plan for it, but what someone just starting out, what are some of the, like, I would say maybe 1, 2, or even 3 considerations they need to think about as they're getting started that they really need to take into consideration that you can think of off the top of your head?
I think criteria gets maybe overlooked. There's a lot of deals out there, right? I want to say deals, like there's a lot of things for sale. And you can get really kind of inundated trying to underwrite all of them. And maybe in the beginning you have to, but if you have sort of a criteria that you can file through that or filter through that pretty quickly, it helps. But I guess to your point of what you were saying, maybe somebody starting out doesn't really know what their criteria is or what it should be or stuff like that. And again, it goes back to just people being different and where they're comfortable. If they're comfortable in low C class and, sort of with some of the stuff that comes with, or they're more comfortable on like newer, nicer assets that you're going to pay a higher premium for and potentially lower returns for. Like, it just depends where people are comfortable. And what was the second part of that question again? I'm sorry.
Oh, it was just things people need to consider if they're getting into different, like maybe some top considerations they really think about. You said criteria first is one of them.
So criteria, like where they fit or want to fit, like what they can sort of bring to the table. And
would you say want to fit or where they fit? Because some people may,
both, right? Because if where they fit and where they want to fit are two different things, then you have to have an honest conversation with yourself. If you want to be a money raiser, for instance, but you don't know a lot of people with money, then
or you're camera shy, or
yeah, you want to be the face of the company, but you don't like getting on the camera. Exactly, a good example.
Yeah, no, absolutely. So we're starting to wrap up. One last kind of the main conversation here, question I have is, what are your thoughts on investing in syndication versus investing locally or just in physical assets yourself on your own? I have that battle. I'm still trying to figure out my route where I go long term. I'm invested in a couple syndications, invested in a couple of multis, and now I don't know. I don't really know what the question is, but what are your thoughts on those who are kind of like against the wall on, do I continue to invest locally or do I join a team, or is it really a personal preference?
I think it's a personal preference, and I think it also is, what do you want to do and where do you want to go? If you invest, I like investing as a limited partner. I think there's a lot of times on a deal, they require a ton of work. At the end of the deal, you're looking at how much a limited partner has made compared to you sometimes, and you're like, man, I wish I was a limited partner on that one.
Yeah.
But yeah, it depends. I think for me, we're going to roll our sleeves up and we're going to try to build this out as best we can. But the idea is to get to a point where we can just kind of put investments into different projects, kind of going forward, that are less time intensive, so to speak. But I don't think anybody on my team really wants to be that guy that's just sitting on a beach kind of sipping Mai Tais all day long. It's like we would all go stir crazy. Yeah. But at the same time, it's like we want that ability if we wanted to.
Yeah, no, absolutely. Oh, cool. All right, now cool. So we're starting to wrap up. So we're starting to get away from the main conversation here. When you're not syndicating, buying multifamily, selling multifamily, what do you do on your off time?
I've got a wife and 4 kids, so they take up a majority of it. There's not a ton of free time, but that's not a bad thing because 4 boys, and they're at that age now that they're very impressionable. 12, 11, and twin 9s. So they're fun, and just trying to do stuff with them and the wife, and so that's where you'll find me.
Absolutely. I didn't realize you had 4 kids. Dang. Okay. Good.
Where these gray hairs are coming from, Brandon.
How can people find you, get a hold of you? What's the best way?
I'd say email, Gwyeth at rustic-capital.com. If you can figure out how to spell my name, you're halfway there.
Got it.
I have a Facebook profile, like personal profile, but otherwise I'm not that much on social media. I am some, but
you're just in the background getting deals done, so it's all good.
Yeah.
So the last thing is, any final words for the audience regarding syndications, multifamily, anything in general that you spoke on?
I would say just follow your path. Don't always do what the crowds are doing. If that's your calling and that's what you want to do, then awesome. But don't get caught up in what everybody else is doing or thinks you should be doing. If single families is your thing and that works for you, then that works for you. If it's large multifamilies and syndications, then by all means go for it. If it's smaller JV type stuff, people got to do what works for them.
Got it. Oh, absolutely. Agreed 100%. All right, so we're going to wrap up. First off, thank you, Gwyeth, and thank you for joining us for another episode of The Agent Investor. We appreciate your time. We want to wish you all the best in your health and happiness. Thank you once again, Gwyeth. You're a great guy. I learned so much from you, and I look forward to maybe catch you in the future on your next deal, and maybe we'll do a deep dive of some kind. But until next time, I am Brandon Rush, real estate agent and investor. This is Gwyeth Smith, and we will see you all later. Thank you so much.
Thanks, guys.